Tip number 3 is evaluate the self-employment tax savings. This is where the tax savings are, right? When you're in business for yourself, you're going to have at least potentially 3, right, types of taxes depending on what state you're in. So you have your federal tax, that's the IRS who governs that, whatever your federal tax rate is. You're going to have state tax if you're in a state that has state taxes. You will have self-employment tax depending on your business structure. Self-employment tax is your contribution to Social Security and Medicare. That's about 15% and change, 15.3. Okay. When you're self-employed, you pay into that tax. When you're employed by someone else, they pay half into that tax and you pay half into that tax. Okay. And so self-employment tax, as you can see, with 15% on top of, let's say, your 22% for federal and then your 5% for state, you can see very easily how you could be at 40, 50% tax rate without any strategies to mitigate your tax liability. So one of the benefits of the S corporation is that a portion of your business profits could avoid self-employment taxes, which is about 15%. And how much you save is going to be dependent once again on that tax profile. Why? When you have an S corporation, and I'll get into this a little bit later, but you have to be set up as an employee of your company. Okay. When you pay yourself as an employee of your company's paying half of that FICA contribution, you're paying the other half. So they're called payroll taxes pretty much. So the payroll taxes and self-employment taxes pretty much are the same. It's just named differently because it's a different structure. So there's no savings in the amount that you're paying yourself because you're either going to pay it through your company and yourself, or you're going to pay it yourself as a self-employed person. However, ideally, you're not going to pay yourself out all of your profit. So let's say your business has $100,000 left after paying all of its other, contractors, operating expenses, $100,000 left. Okay. If you determine that a reasonable compensation for yourself is $50,000, you're going to pay yourself $50,000. There's going to be some taxes paid on that $50,000. Let's just say you have $50,000 left over. That $50,000 is not going to be subject to self-employment taxes. It's going to be subject to income taxes. Don't get me wrong with that, but you will avoid the 15% on that income that is left. Whereas if you were an LLC or a sole proprietor, the whole $100,000 is subject to self-employment tax. So how much that savings is for you, it depends on what your reasonable compensation is. That $50,000 number I gave you. What if your reasonable compensation was $95,000? Then that means only $5,000 of your profit is saving self-employment tax. And is it really worth it, right? What if your reasonable compensation is $30,000? Then you got $70,000 that you're, avoiding paying self-employment tax on. So you can see why it gets very detailed and meticulous to determine, based on your reasonable compensation, based on the profitability of your company, if the S election would really save you or not. Potentially it could. Okay, so that's why it's important to evaluate that self-employment tax savings with a tax professional and look at all of those different pieces. Okay.